We spend a lot of time on these deep dives, dissecting really complex problems, things like supply chains, geopolitical shifts, the future of AI.
We're always looking for that hidden key, right? That little piece of information that unlocks the whole thing.
Exactly. But I want to start today with a premise that's a little bit uncomfortable. What if the biggest threat to your financial health isn't ignorance?
Yeah.
What if it's not some complex derivative you don't understand, or like high-frequency traders gaming the system?
That is an interesting setup. Usually we assume the problem is what we don't know. You're suggesting the problem is what we think we do know.
Precisely. I'm talking about the common wisdom,
Mhm.
the phrases that get tossed around at dinner parties or on, Reddit threads.
Ones that sound so intuitively correct.
Yes, so logically sound that we just nod along.
But
But we're looking at a source today called Debunking Common Investment Myths and Timing Traps. And it argues this so-called wisdom is actually a quiet wealth killer.
it's not a scam that blows up your account overnight. It's a slow leak. And I'm really glad we're tackling this because the source material makes a great distinction between bad advice and myths.
What's the difference in their view?
Well, bad advice usually smells like bad advice.
Yeah.
A stranger telling you to put your life savings into a coin named after a dog.
Right. You can see that one coming.
But myths stick around because they feel true, they feel prudent, and that makes them infinitely more dangerous because you can follow them for 20 years thinking you're being responsible.
Well, you're actually just drastically underperforming.
Zach.
The source calls it quiet underperformance, which, to be honest, that scares me more than a crash. A crash is a loud event, you can see it, but waking up at 60 and realizing you're 30% behind where you should be because you followed common sense, that's a tragedy.
It's the invisible opportunity cost.
Hmm.
And the source targets 7 of these rules. But there is one that really stands above all the rest.
The grandfather of them all.
It really is. The ultimate investing cliche.
I have a feeling I know which one you mean. I was actually thinking about this the other day because I was looking at a chart of NVIDIA, and I realized I sold a chunk of it years ago.
Oh, no.
Yeah. I thought, okay, surely it's peaked. I'll buy back in when it drops. Spoiler alert. I never bought back in.
Classic. You're trying to follow the golden rule.
Buy low, sell high.
Buy low, sell high.
Right. It sounds so perfect. It's elegant. It's basically a tautology. Of course I want to buy cheap and sell expensive. That's the definition of profit. So why on earth does our source call this a trap?
Well, that's the tricky part. Mathematically, buy low, sell high is a perfect description of a profitable trade. But as advice, as a strategy for a human being to follow, it's catastrophic.
How so?
The source uses an analogy that I think is brilliant, if a little dark. They say telling an investor to buy low, sell high is like telling a clinically depressed person to just be happy.
Just be happy. Wow, okay, I get that. It identifies the destination but gives you zero map on how to get there.
Precisely. Be happy is the goal. It's not the method.
Mm-hmm.
And buy low, sell high describes a winning outcome, but it offers no way to identify low or high in the moment.
It assumes you have this clarity that just doesn't exist when you're in the thick of it.
Right.
But hold on, let me play devil's advocate. Isn't that what value investing is? You look at a PE ratio, you say, this is historically cheap, and you buy. Isn't that buying low?
That's a really crucial distinction. Value investing is about analyzing the fundamental worth of a business. Buying low in the context of market timing, which is what most people mean, is betting on price movement.
It's just looking at a chart.
Exactly. It's looking at a chart and saying, this has gone down, so it must bounce back, or this has gone up, so it must crash.
Yeah.
And this leads to what the source calls analysis paralysis.
Analysis paralysis, I have definitely felt that. You're sitting on cash, the market is ripping upward, and you're thinking, I can't buy now, it's an all-time high, so you wait.
You wait for the low. But let's play that out. Say the market drops 10%. Now it's low relative to last month. Do you buy?
Well, usually no, because if it drops 10%, the headlines are screaming about inflation or war or recession. So now I'm thinking, what if it drops another 10%? I don't want to catch a falling knife.
Exactly. When it's high, it feels too expensive. When it's low, it feels too dangerous. So you just sit on the sidelines.
For both the rally and the correction.
You miss everything. The source quotes that famous Wall Street adage, nobody rings a bell.
Nobody rings a bell at the top or the bottom. It's so true. In hindsight, the bottom of 2008 or March 2020 looks so obvious. It's just this sharp V on a chart.
Yeah, you can point right to it.
But I remember 2020, in the moment, it didn't feel like a bottom. It felt like a bottomless pit.
And that's the reality. And here is where the common wisdom really betrays us.
Hmm.
We think, okay, maybe I can't time the market because I'm just a guy with a smartphone, but surely the pros can.
You would assume so. The hedge funds with the billion-dollar algorithms and the, satellite imagery of parking lots.
It's literally their job. They charge 2 and 20 for that privilege.
Yeah.
And yet, the source is emphatic on this point. Even the professionals consistently fail at this. Most active managers underperform their benchmarks over a 10 or 15-year period.
So if the PhDs can't do it, my chances are what, statistically zero?
Effectively, yes. But for the retail investor, for us, it's actually worse than zero. We don't just fail, we actively sabotage ourselves.
How so?
The source describes a cycle driven by our biology. We are wired to seek safety in the herd. So when do we feel safe enough to buy?
When everyone else is buying. When my neighbor is bragging about his returns, which means prices are already high.
And when do we feel the urge to flee?
When the market crashes and everyone is panicking, which is when prices are low.
So we are biologically hardwired to do the exact opposite.
We're hardwired to buy high, sell low.
We are momentum chasers on the way up and panic sellers on the way down. But let's move away from the psychology for a second and look at the actual cost, because the source cites some devastating research from Morningstar.
Oh, the Mind the Gap study. I read this section 3 times because the numbers didn't make sense to me at first.
It's pretty shocking.
So Morningstar looked at the returns of mutual funds versus the returns of the actual investors in those funds.
Right.
But wait, if I own a fund and the fund goes up 10%, I go up 10%, how can there be a gap?
That assumes you bought on January 1st and didn't touch it. That's a time-weighted return.
Yeah.
But Morningstar calculates the dollar-weighted return, which looks at when money actually flowed in and out.
Ah, okay.
And they found that the average investor trails the fund they own by approximately 1.2 percentage points per year.
1.2%. I have to be honest, if you told me I lost 1%, I'd probably just shrug. It sounds like a rounding error.
It sounds tiny, I agree. But in the world of compounding, 1.2% is enormous. Over a 30-year investing horizon, that 1.2% drag can reduce your final portfolio value by 20 to 30%.
Wow. That's hundreds of thousands of dollars. That fee is the price of trying to outsmart the market. It's the behavior gap.
It's entirely because people are jumping in and out at the worst possible times. They pile in after a fund has had a hot year buying high, and they bail after a bad quarter selling low.
You're just constantly chasing past performance. It's like driving by looking exclusively in the rearview mirror.
That's a great way to put it.
Yeah.
And speaking of missing out, the source brings up another statistic that I think is the single most compelling argument against market timing.
I think I know where you're going. The 10 best trading days.
Yes. This part just blew my mind.
Walk us through it.
So the source looks at a 20-year period. If you stayed fully invested, you got the market return. But if you tried to time things and you happened to miss just the 10 best trading days.
10 days out of roughly 5,000 trading days.
Just 10. If you missed them, your returns were cut in half.
Half. That is terrifying.
It really is. It shows how concentrated market gains are. The market doesn't go up a steady, 0.05% every day. It does nothing for months, drops, and then explodes upward.
And if you aren't in your seat for the explosion, you've missed most of the trip.
You've missed almost everything.
But here's the part that feels like a cruel joke. And this is why people miss those days. When did those best days even happen?
And that is the cruel paradox. The source notes that the best days almost always occur within 2 weeks of the worst days.
Let's just visualize that. The best day isn't some sunny Tuesday when everything is calm.
No. The best day usually happens in the middle of a crisis. It's 2008 or it's March 2020. The news is apocalyptic. Your portfolio is down 20%.
You feel physically sick looking at your brokerage app.
And your instinct is screaming, sell everything, go to cash, wait for the dust to settle.
And if you listen to that instinct,
you sell. And then, usually the very next week, the market rips upward 4 or 5% in a single day, a relief rally.
Yeah.
And you are sitting in cash.
So you took all the pain of the drop, but you locked in the loss and missed the recovery.
It's the worst of all worlds. The source is arguing that you cannot surgically remove the bad days without also accidentally removing the good days. They're a package deal.
Okay, so we've established that buy low, sell high is a trap. We know the data says we'll miss the best days if we try. We know this behavior gap costs us serious money. So
yeah,
what's the alternative?
The source offers a solution that hacks our own behavior. It's a strategy called dollar cost averaging.
Dollar cost averaging. I have to say, it sounds incredibly boring. It sounds like something my accountant would whisper to put me to sleep.
It is boring, and that's the whole point. But the mechanics are fascinating because they actually mathematically exploit volatility.
Okay, walk us through the math, because I think people get the idea, invest regular amounts, but not why it helps you buy low automatically.
Sure. Let's say you commit to investing $500 every month into a fund. In month one, the share price is $10. Your $500 buys 50 shares. Simple enough.
Right.
Now the market crashes. The share price drops to $5. This is the moment where normally you'd be terrified, but your automatic $500 transfer goes through. At $5 a share, how many shares do you buy?
You buy 100 shares.
Exactly. You just doubled your purchasing power.
Yeah.
You didn't have to make a decision. You didn't have to summon the courage to buy the dip. The math just did it for you.
You automatically bought more shares when they were cheap, and you bought fewer when they were expensive. So it creates this weighted average.
Right. It lowers your average cost per share over time. It creates a spring-loaded effect, so when the market eventually recovers, you become profitable much faster because you accumulated so much at the bottom.
And it really solves the emotional problem, doesn't it? Because if the market drops, I can kind of tell myself, hey, good news, next month's contribution is going to get a great deal.
It reframes the downturn. Instead of a disaster, it's a sale. The source emphasizes that this strategy, a diversified portfolio, automated contributions, it removes the stress of guessing.
I do have to push back on one thing, though, the counterargument. If the market generally goes up over time, wouldn't you be better off just putting all your money in as soon as you have it?
Mathematically, often, yes. A lump sum investment wins about 2/3 of the time because markets trend up. However, and this is a huge however, that assumes you act like a robot.
Which we've established we do.
Exactly. If you have $100,000 to invest, are you really going to dump it all in today? Or are you going to hesitate? DCA might not be mathematically perfect, but it is behaviorally perfect. It gets you into the market.
It's the difference between the perfect diet that you quit in a week versus the pretty good diet that you can stick to for 10 years.
That's a perfect analogy. As the source says, it's not attractive. It's a grinder's strategy. You can't brag about calling the top at a cocktail party.
True.
But then they drop this line, which I just love. It's not attractive, but neither is retiring broke.
Neither is retiring broke. That's the reality check. We treat investing like it's a game or a skill challenge, but the stakes are our actual lives.
It really puts the choice in stark terms. Do you want excitement or do you want results? The data shows the boring way is the way that works.
It's funny, we started this talking about how bad advice is disguised as common wisdom, but good advice, dollar cost averaging, is almost disguised as apathy. It feels like you're doing nothing.
We're conditioned to believe that effort equals results. If I want a promotion, I have to work weekends. So we assume to get better investment returns, we have to work harder.
We have to trade more, read more news, watch more charts.
But in investing, activity is often the enemy of returns. The laziness of automation is actually a form of discipline. It takes immense discipline to just do nothing when the world is going crazy.
Ben Graham said the investor's worst enemy is likely to be himself.
And this is the system that protects you from yourself.
So let's bring this all together. The message is pretty clear. Buy low, sell high is a myth, not because the math is wrong, but because the human is flawed.
And the data confirms it. The Morningstar gap, the 10 best days data, it all shows that trying to dodge the pain usually means missing the game.
And the solution is to embrace the boring. Let the math of dollar cost averaging do the work. Stop trying to outsmart the system.
Basically, yes. Build a system that protects you from your own amygdala.
Before we wrap up, I want to leave our listeners with one final thought. We've talked a lot about risk today. And usually, when people think of risk, they think, what if the market crashes and I lose money?
That's the visible risk, the volatility.
But based on everything we've discussed, missing the best days, that 1.2% gap, it seems like there's a totally different definition of risk we should be using.
This is the paradigm shift. If you are a long-term investor, volatility isn't risk. The price going down temporarily isn't risk.
So what is the real risk?
The real risk is the guaranteed permanent loss of purchasing power that comes from sitting on the sidelines when the recovery inevitably happens.
If you're in the market and it goes down, you have a paper loss. If you're out of the market and it goes up, that's a permanent loss of opportunity. You never get that growth back.
Exactly. The biggest risk isn't being in the roller coaster when it goes down. It's getting off the ride halfway through.
Well, on that note, we're going to wrap up this deep dive. Hopefully we've given you permission to be a little more boring with your investments.
And hopefully a lot richer for it.
Yeah.
Boring is beautiful.
Thanks for listening. We'll catch you on the next deep dive.